Hey everyone, and welcome back to another video for today. So in today's video, I do want to discuss the current situation around Oscar Health, what I'm doing, what I will be doing, what I will not be doing. We also will have a look at CoreWeave's earnings report and Rocket Lab's as well. Rocket Lab right now is up 7.3% after hours. CoreWeave is down 5.3%. And so without further ado, let's start off with Oscar. If you enjoy this type of videos, hit all the buttons. Would really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment to the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So Oscar Health, as you can see on Monday, was down 17.5%. We're now at $14.62. It's currently experiencing a drawdown of close to 35%. Year to date, stock is still up 8%. At one point, it was up 60%. It's a company worth a bit less than $5 billion. Now, on Monday, of course, the markets were green because the government shutdown was ending or is going to end. The only problem here is still this, the ACA subsidies extension. Now, there are two different types here, two different things. One, the ACA, or the Affordable Cares Act, often called Obamacare, was a law enacted in 2010. Its main goals were to make health insurance more available and affordable for more people and to reform the health insurance market. That's really, in short, you have to fall into a specific bracket in the United States in order to get into this. Now, in 2021, the American Rescue Plan enhanced the original ACA subsidies, making them much more generous. These subsidies are set to expire at the end of 2025. And that's basically what this whole thing is about right now. It's about voting on, in December, that is, mid-December, voting on whether or not these subsidies will be extended. So we have three risks here. One, the expiration of enhanced subsidies, a potential structural overhaul by redirecting payments, right? This was a post made by President Trump talking about, okay, maybe let's just redirect the payments. Let's not make payments to the likes of Oscar, but let's make payments directly to the individuals and let them make their own choices. We're going to talk about that in a bit. And then the third one is the really worst case scenario, is the ever-present political threat of a full legislative repeal. Basically taking the ACA or Obamacare and saying, thank you, goodbye, it's gone. The likelihood of that happening is quite small. But the other two, well, especially the first one, is very big. The second one is a proposal. Now, the second one, if you are, let's say, realistic, then you're going to say, okay, the idea might be good, but realistically speaking, I don't think it will change much. And how does that impact a company like Oscar, for example? Well, first of all, if we go here on Kalshi, again, the volume on this one is quite low, but you can see that the question here is, will the Affordable Cares Act premium tax credit be extended? It's now at 22%. Well, a day ago, it was at 52%. But coming back to this right here, talking about Oscar. Okay, on the one side, you're saying, okay, you know what? Actually, if the money does not go to the insurance companies, if it goes to the individual, then the individual will have enough money to buy its own program. Well, yeah, that could happen in an ideal scenario. In a non-ideal scenario, which I think is a bit more realistic and what I think might happen, is, okay, people will get a certain amount of money. They will go and shop for their plan. Some of them will find maybe a plan that is in their budget, but maybe a lot of them will find plans that are suddenly higher than what they've got, right? Higher than the amount of money than what they've got. And so they'll have to pay more out of their own pockets, which could also mean that for Oscar, for example, they will see the total addressable market, or their own market, shrink, because maybe the younger, healthier folks out there will say, you know what, if it's so expensive, I'd rather not. But you know who would still pay the price? The older ones, the ones that are sick a lot more times, which is definitely not good to have a higher concentration of these types of risk profiles for a company like Oscar or United Health or any of the other companies out there, right? higher mobility rates is what led us to, well, the whole crash in the market this year. That's the problem. That's the problem. Now, luckily for us, we already have a couple of answers going into 2026 from ICHRA. Right, so ICHRA has adopted a disciplined pricing strategy designed to protect its financial stability regardless of Congress's actions. So ICHRA has priced its 2026 plans assuming the subsidies will not be in place, the enhanced subsidies, resulting in a weighted average rate increase of approximately 28% across its offerings. This elevated pricing also accounts for a higher market morbidity observed in 2025. Now, to combat the sticker shock from the higher rates, ICHRA is strategically directing members to lower cost points, including new $0 gold and bronze plans, and diversifying its mix to capture various demographics. By pricing this way, ICHRA is aiming to ensure resilience against market changes and position the company for profitability and margin expansion in 2026. So, at least we've got that one covered, because they are already, in some ways, protecting themselves for maybe not the worst of worst case scenarios, but a bad scenario nonetheless. Now, the bad scenario is that second point, right? That second point right here. But to be honest, again, that second point right here is still far-fetched, in my opinion. Now, another way ICHRA is, of course, trying to reposition the whole company for the long-term future is ICHRA. So ICHRA is a system where employers give employees tax-free money to buy their own individual health plan instead of offering a traditional group plan. And this was from their presentation back in 2024. We didn't get an updated one, so I assume the numbers here are still the same until management changes their mind or changes their own estimates. So this was about it. Individual market growth is sustainable with additional upside if enhanced subsidies extend beyond 2025. So this is the case for 2027 with subsidies, individual market size, and without the subsidies. But you can see here a nice increase already in ICHRA, 24 million. Now, that's not all. They have a clear path to expand their individual market opportunity. 2027 ICHRA in market opportunity. In 2024, they've got here 10 million. New market product expansion, you add here 6 million, and then the 4 extra million here is only with the enhanced subsidies. But ICHRA is a way for ICHRA to make sure that in the future there will not be any, this will happen with ACA, that might happen with ACA. No, they want to make sure, because right now, yes, the large majority of their business comes from the ACA marketplace. We all know that. But we also know that they have been making moves towards making sure that they're growing in this market. Well, you can call it a market. I do think that ICHRA is going to be quite big. Right now, back in 2024, ICHRA employer adoption, 171% growth of employees offered ICHRAs between 2022 and 2023. And based on the last comments we got from, the last earnings call, they said the following thing. ICHRA views ICHRA in conjunction with ACA as having the potential to meet the healthcare needs of approximately 120 million working individuals. This strategy aligns with broader macroeconomic workforce and consumer trends, including the growth of the service economy, the demand for affordable benefit options, and increased consumer choice in healthcare. ICHRA also anticipates a continued conversion to ICHRA from small and mid-sized employers, particularly those facing double-digit group rates increases. This momentum reflects a growing demand among employers for a wider range of affordable and innovative benefits. And here we have ICHRA CEO talking about the huge potential.
So this idea of letting people have employers give the money that they are otherwise used for health insurance, give it to the employees and let them buy it, is called defined contribution. We did it with pensions 20, 30 years ago. Now the time has come to do it with health insurance, now that we have a fully developed, the largest risk pool in America, the ACA market, and now turn it into an individual market for everyone. We can do it for gig workers, where they can create hour banks and just put away so much and then go out and buy their health insurance from the individual market. So the total individual market has an opportunity to hold 125 million lives, which would make the risk pool even more stable and less costs. So the time's coming. So there is legislation introduced in the current bill on making ICHRAs move forward, helping ICHRAs move forward. And this is sort of the potential size of the market. The chart before was the relative rate of increase on trend versus employer market and CPI. So we really think we have a product here that's the future, where Americans can buy what they want, have the network they want, and keep the product they want over time, and have a much more stable experience, and not have to change your insurance every time you change your employment or you go to a different part of your life.
And so right now, as long as there isn't the worst case scenario, as long as this doesn't change right here, right? This is basically their 2027 goals. Revenue, 20% CAGR from 2024, operating margin of around 5%, and EPS of above $2.25. EPS of above $2.25 for a company that's trading at right now, what did you say, less than $5 billion in market cap. Price per share is between $14 and $15. If they can achieve that, then yes, it is quite cheap today. And so right now we are here. We are basically no man's land on the daily. We are below the 200-day moving average. If tomorrow is another red day, might not surprise me if we're going to be oversold on the daily. If we look at the weekly right now, we're also under the 100 and the 50-day moving average. The 200-day one sits at around $11. Do I think it will go all the way down to $11? No, I don't think so. But you never know with this market. What am I doing right now? Right now, I am sitting on my hands and waiting to see if I can get more information on this whole situation. Because I already have a position. In order for me to increase that position significantly, I would need a lot more information around whatever is going on right now. Will I have to wait a month to get that information because maybe the vote will only happen a month from now? Yes, okay, fine. Then we'll wait a month. And I'm in no rush with this position since I'm still building this one up. Moving on to Rocket Lab. So Rocket Lab, very good quarter. Stock is up 6-7% right now. So we've got here record revenue, highest gross margin yet, largest launch backlog ever, 16 times 100% mission success in 2025. They're going to Mars, and Launch Complex 3 has been opened. This has been a very, very good quarter for the company revenue-wise and also gross margin-wise. Now, we know, we talked about Electron. Electron has got quite a lot of new contracts as well. Electron is growing. If you look at the launch backlog right here, year to date, increased 56% growth for the year. Very, very good. Now, of course, you all want to know, okay, cool, Electron, space systems, the acquisitions, you name it. I'm not going to be surprised if they are going to acquire another small company along the way. Now, if we go and look at, of course, the big thing, which is Neutron, right? Because Neutron is the next big thing. We can see the following thing. Launch. Our current plan for Neutron has the rocket arriving at Launch Complex 3 in Q1 2026. So Neutron has been delayed. Neutron has been delayed to at least Q1 2026. Now, I would have assumed, I think we all would have assumed that, okay, this would have maybe pushed the stock down. It didn't happen. We have a delay, but the stock is not down. Well, at least right now. Maybe tomorrow when the market opens, it will. But who knows? But they said what they've said before and what we've discussed during the live streams as well. They are not in the rush to launch Neutron just for the sake of launching it. They said, look, we've spent quite a lot of money building this thing. We're not going to launch it and not learn anything that we couldn't have learned when this thing was on the ground. When they will launch it, they will try to go to orbit and actually learn quite a lot from that launch. Now, of course, that will have consequences on the cadence, right? Because the moment that they launch the first test launch, no revenue comes from that. But revenue will come from the ones after that. Over a 12-month period, I think that says three launches or so. And so that as well is not certain to be all of it in 2026. And it depends on the first Neutron launch test. And then you have to look 12 months out, and then you start with that cadence. We'll see. Now the bar has been set, Q1 2026 at least. We'll see what happens. But in the meantime, In the meantime, as you can see, the business is doing very well. $155 million in revenue, 48% year-over-year growth. Backlog, $1.1 billion here, growing quite nicely. Expenses are fine, in line, I would say. GAAP EPS, loss of 3 cents for the quarter. Q2 2025, that was a loss of 13 cents for the quarter. If we look at the outlook, this is basically it. They expect revenue in the range of $170 to $180 million. They expect year-on-year increases in both space and launch revenue. GAAP and non-GAAP gross margin. GAAP gross margin between 37 and 39%, driven by operating leverage and launch pricing improvement. More on that in a bit. They expect non-GAAP between 43 and 45%. Adjusted EBITDA loss between $23 and $29 million. Now, as for the pricing, this has been an amazing quarter. Revenue value per launch for the quarter, record, $10.1 million. If we look at the cost per launch, $5.9 for the quarter. So, again, Rocket Lab doing exactly what it should be doing. Yes, for now, very focused on Electron, on haste. But Neutron is, yes, still behind the corner, delayed, but so what? So what? If you do believe that this is a $100 billion company in the making, a little delay here and there, it's not such a big deal. I would have loved to see the stock come down significantly, but it is what it is. The stock right now is up $6. It's going to be quite close to the 50-day moving average. We're basically here between the 50 and the 100-day moving average. Moving on to CoreWeave. So as you can see, CoreWeave is down right now around 5.8%, let's call it 6% or so. According to chat during the live stream, the implied move was around 15%. So I assume that maybe tomorrow when the market opens, this can go down even lower. Or we can see a reversal. Now, what exactly has happened with CoreWeave? Was it a bad quarter? No, not at all actually. Revenue $1.4 billion, up 134% year over year. Revenue backlog $55.6 billion, up 271% year over year. And I believe doubled or more than doubled quarter over quarter. CapEx $1.9 billion, adjusted EBITDA $838 million, 61% margin, adjusted operating income 16% margin, and adjusted net loss, negative 3% margin here. They say this, look at this. Look at this growth for CoreWeave, adjusted operating income, same thing there. They do tell us a little bit more here below with regards to the backlog. Revenue backlog almost doubled quarter over quarter. The year-over-year increases were driven by large deals with customers, including OpenAI, Meta, and multiple hyperscalers. And so you're going to say, okay, all of this is great. So why is the stock down? Why is the stock down? Well, the stock is down because of a guidance. There has been a small delay, so that's impacting guidance. Now, that said, the contract is still intact. It's just now that there is a delay, so you're not getting the same amount of revenue expected for the upcoming quarter, but the client has agreed to basically prolong the deadline. Contract is still intact, client is still expected to pay the same amount of money, still expected to get the same amount of compute power and all of that. So is it an overreaction by the market? I don't know, because the market doesn't like delays. Okay, the market doesn't like delays, and if it happens once, maybe it can happen again in the future. It's not a delay because of CoreWeave, it's a delay because of one of the partners that CoreWeave is working with. As for CapEx, they do expect CapEx to be in excess of double that of 2025. Cloud customization is the differentiator, does not see power as a bottleneck. Okay, interesting. And there's no impact on our ability to bring on more clients. Delays will only relate to one specific data center. And so here we are right now back at $100, which was basically the bottom on Friday. So all in all, that's about it for me in this video. Oscar situation explained, Rocket Lab, CoreWeave. Of course, don't forget, tomorrow morning we do have a Nebius. We're going to be live. The live stream is already scheduled, so click that notification bell so you don't miss any of those. See you all in the next one. Bye-bye.